There's a new kind of risk quietly shaping how companies make decisions in 2026, and it's not the kind of risk businesses used to fear. It's not just about competition, it's not just about rising costs, and it's not even just about economic downturns. The risk companies are now trying to avoid at all costs is getting stuck, not failing fast, not losing money in the short term, but becoming trapped in a position where they can't move, can't adapt, and can't respond when the market shifts again. And once you start looking at business decisions through that lens, a lot of what companies are doing right now starts to make sense. For years, businesses were built around taking bold risks, expand into new markets, launch new products, scale as quickly as possible. If something didn't work, you pivoted and tried again. But today, the consequences of certain decisions are becoming much harder to reverse, and that's the real danger. Take large investments, for example. In the past, companies were willing to commit huge amounts of capital to new ideas, infrastructure, or expansion strategies. But now, many are pulling back, not because they don't see opportunity, but because they're worried about being locked into the wrong path. If you invest too heavily in one direction, whether it's a technology, a market, or a business model, and things change, it's no longer easy to pivot. The cost of switching has gone up dramatically. This is especially true in areas like supply chains, AI infrastructure, energy, and long-term contracts. These aren't short-term bets, they're multi-year commitments. And if the assumptions behind them turn out to be wrong, companies can find themselves stuck with decisions they can't easily undo. That's why flexibility is becoming more valuable than boldness. Companies are now asking a different question. Not how big is the opportunity, but how hard will it be to change direction if this doesn't work? That shift is subtle, but it's changing everything. You can see it in hiring. Instead of aggressively scaling teams, many companies are staying lean or hiring in very targeted ways. It's not just about controlling costs, it's about avoiding organizational rigidity. Large teams are harder to restructure, slower to adapt, and more difficult to manage when priorities shift. So businesses are building teams they can adjust, not just teams that can grow. The same thing is happening with expansion. In the past, entering new markets was a sign of ambition. Today, it's approached more carefully. Companies are testing markets in smaller ways before committing fully. They're using partnerships, pilot programs, or limited rollouts instead of going all in from the start. Why? Because pulling out of a market is often more damaging and more expensive than not entering at all. Another major area is pricing and customer strategy. Companies are becoming cautious about pushing customers too far. Yes, prices are rising, but businesses are also aware that if they cross a certain line, they risk changing customer behavior in ways that are hard to reverse. Losing trust, losing loyalty, or pushing customers to alternatives, even slowly, can create long-term damage, and once that shift happens, it's difficult to bring customers back. So the goal is no longer just to maximize short-term gains, it's to avoid triggering long-term consequences. Technology decisions are also being shaped by this new risk. There's a massive push toward automation, AI, and digital transformation, but companies are no longer adopting everything at once. They're being more selective, more cautious about which systems they build around. Because once a company commits to a certain technology stack, switching later can be incredibly complex and expensive. Integration, training, data migration, it all adds friction. So instead of chasing every new trend, businesses are thinking more about long-term compatibility and adaptability. This idea of getting stuck also applies to business models. Many companies are rethinking how dependent they are on a single revenue stream, a single customer segment, or a single strategy. Over-reliance can create vulnerability. If something changes, market conditions, regulations, customer behavior, the entire business can be affected. Diversification used to be about growth. Now it's about flexibility. Even supply chain strategies reflect this shift. A few years ago, companies rushed to localize everything to reduce risk, but that came with higher costs. Now they're trying to balance resilience with flexibility, avoiding systems that are too rigid in either direction. Because a supply chain that's too concentrated is risky, but one that's too complex can also be hard to manage and adjust. And then there's the financial side. Debt, long-term obligations, and fixed costs are being scrutinized more than ever, not just because they're expensive, but because they reduce flexibility. High fixed costs make it harder to adapt when revenue changes. Long-term debt limits strategic options, so companies are becoming more cautious, not just about how much they spend, but about how committed they become. What's interesting is that this new risk doesn't show up immediately. A company can look successful on the surface, growing, profitable, expanding, but still be at risk if it's too locked into its current path. Because when the environment changes, speed and flexibility matter more than size or momentum, and that's exactly what businesses are preparing for. They're not expecting stability to last forever. They're expecting more change, just harder to predict change. And in that kind of environment, the biggest advantage is not being the fastest or the biggest. It's being able to move when needed. That's why so many decisions today feel more cautious, more measured, even slower.